All right, so let's discuss 2014 global stock markets prospects. Strong U.S.-led economic growth, higher yields, and solid U.S. stock gains that are lower than in 2013 but higher than consensus. Meanwhile, a rising U.S. dollar and rising rates as well as rising rate volatility will have consequences for markets around the world as credit cycles diverge. As we move into 2014, we expect this trend to moderate but to continue forward, even with the Federal Reserve tapering mid-year. Our analysts summarize the macro story of the year as inherent upside risk in a vigorous bull market by the US dollar and a low but rising interest rate environment. In 2013, we saw the 30-year bull market in bonds went down and stocks soared with a stronger recovery since 2009 than in the last 5 market cycles. As we move into 2014, we expect this trend to moderate but continue forward, even with the Federal Reserve tapering mid-year once again. Bearish on rates and commodities, long on volatility and bullish on real estate and equity, we expect a shift to lower liquidity per higher growth in 2014 and overall positive asset returns. Rejecting the outright bear market case for equities, analysts remain optimistic about the stock market gains in the near term as high-quality U.S.-based companies with global exposure unleash value. However, they advise to move to middle ground, shedding the extremes of high yield and high stocks as long-term trends in the great global rotation continue to play out. These are 10 of the following macro calls for the year ahead. Pay attention. The S&P 500 index is expected to rise to 2,000, and the MSCI All Country World Index reach 444 by year end. Gains in the year ahead imply a price return approximately 11% with modest earnings growth of 7%, driven by higher sales and additional buybacks. 2. U.S. and global economic GDP growth is expected to accelerate in 2014 to 2.6% and 3.5% respectively. The U.S. economy is expected to expand in the second half of the year at a 3% rate, driven by the end of the fiscal austerity and the pent-up demand for capital goods. Slow growth of 0.8% is expected in Europe as credit and fiscal policy remains tight. China's GDP growth will marginally decline 7.7% in 2013 to 7.6%, but remains highest amongst the leading emerging market economies, while Japan is in transition with another year of 2% growth. Another one, modest rebound for emerging markets. Following flat-line growth since 2007, the emerging markets should prove resilient in 2014 with modest growth recovery and rising productivity. Emerging market GDP is expected to rise 4.9% this year, with modest returns of 2.9%, 0.7%, and 0.3% for local debt, emerging market foreign exchange, and external sovereign debt. Another, U.S. rates to head higher, with 10-year Treasury yields expected to reach 3.75%. A rise in the Treasury yields by 85 basis points will have consequences for markets around the world, likely resulting in an increased rates of differential in favor of the U.S. dollar, especially against the euro, which is expected to decline to 1.25 by the year end. In addition, rising rate volatility may surprise interest rate volatility and expected going 2014. With a target of 100, the Merit Option Volatility Expectations Index, market complacency over the time and impact of the Federal Reserve tapering could leave some investors unprepared for rising volatility in rates. Long vol positions in the U.S., rates and loan swap spread positions are favored as insurance against higher interest rate volatility. Challenging year for fixed income. Tightening spreads and rising rates could make total returns challenging for fixed income investors. Corporates are favored over government bonds. High-yield bonds are expected to produce positive returns, though about half of the gains seen in 2013 U.S. high-yield bonds may offer the best potential with a total return of 4% to 5%. Among investment-grade bonds, Europe should really lead the way to a return of up to 2%, followed by the U.S. 1.5%, while Asian emerging markets may suffer negative returns. Finally, global inflation rate to remain stable to close to 3% after surging in 2011. Inflation has fallen in almost every country with the exception of those facing foreign exchange fuel prices increases, namely Japan, Brazil, India, and Turkey. Inflation in emerging markets is expected to increase, and that's something. And the U.S. housing recovery continues. The ongoing strengthening of the U.S. economy is expected to boost real estate values by another 5% in 2014. Oversupply to contain commodities pricing. Global commodities prices will contain in 2014 by oversupply in key sectors, especially global oil and grain, and a strong U.S. dollar and modest global economic growth. Our commodity is expected to decline about 1.6%, less than the steep 5% decline in 2013. Gold values are expected to drop to $1,250 an ounce in the first quarter before rebounding to normal levels later in the year. Other metals not in surplus, including zinc, platinum, and industrial metals, could outperform. 3 Bs. Corroborate evidence of great rotation, higher bond yields, a higher buck, and a higher bank stocks, which is a leading barometer of domestic demand in 2014, will corroborate evidence of a great rotational shift in the markets, outperformance of real estate over commodities, stocks over bonds, and developed markets over emerging markets, small cap over large cap, high yield over investment grade, and cyclical over defensives. The shift will continue in 2014 with the Fed tapering causing little, if any, pause in the process. Institutional reverse rotation, while the attractiveness of equities lures retail investors away from bonds, institutional investors, including insurers, sovereign wealth funds, central banks, and even the U.S. pension funds, are expected to take part in a reverse rotation, selling stocks and buying bonds. This is it. Thank you.